Hello everybody, it's Henry Becker with Lighthouse Wealth Management. Wanted to reach out with a video regarding coronavirus in the markets. This current week, today I'm filming on the 27th of February. This week has been pretty volatile to the downside with a lot of, call it scary headlines regarding coronavirus. And the markets are coming down as we see more and more of these headlines. Now, as would be expected, the market reactions have a lot to do with the headlines we're seeing, and the media is doing its best to scare your socks off, more or less. So to be sure, the spread of this virus is a concern, and we're not going to take it lightly or try to diminish its impact on economics or people in general. But wanted to share a few of our thoughts with you. Let's face it, investors have enjoyed a very long period of good market returns. In some areas of the market have gotten stretched. When you get stretched markets and you get a scare or unknown like coronavirus in the markets, you're going to see people taking profits. Now, keep in mind that when you take profits, it's not a testament, usually it's not a testament against or for a particular business or market. It's usually part of a strategy. Most investors, especially institutional investors, will have limits, whether it's to the downside or to the upside. So for us, we look at this as, again, we have some stretched sections of the market, and when markets get stretched, if you get a little scare, people have itchy trigger fingers, they're going to hit that sell button usually a little faster than they would. Before we get into the current market dynamics any further, I want to say that we've been here before in the recent past, in 2003, 2015 with SARS and the Zika virus respectively. And in both cases, the market dropped almost 13% in both cases over a few month period, only to recover back to their previous level within a few months. So while this is a more severe virus and the impact of the virus is more severe, we do expect, especially time frame of the year, we do expect that with history as a guide, that this more than likely is going to be temporary, just like the other two have been. As I said in the last statement, at the end of the last statement, we believe this will be temporary. The impacts of coronavirus, while companies are scaling back, countries are restricting movement and those types of things, there will be softer numbers ahead from companies and countries' productivity, like GDP numbers and so forth. But on the other side of it, we expect that we resume back to a normal growth trajectory in a lot of these places, because there's going to be a lot of catch up to be done as well. So bottom line, we view this as temporary, and we think if the past is any indication, we're looking at a few months of some economic pain and companies retrenching some numbers. Be assured, some of our models are built with downside triggers where, technically speaking, we will start taking risk down when we see certain events happen with those investments. Some of our other models, just by nature, take less risk than the overall stock market. And then, as always, we just stand ready to remove risk if we think the situation warrants taking more cover for clients. If history is our guide, this is going to be, again, a temporary problem. And it's not delightful to go through in any form or fashion, especially for people that are suffering from the disease or wringing their hands over being close to it. But the reality is, from an economic and investing standpoint, we're going to see softer numbers from countries and companies in the days ahead, because earnings releases, GDP are all backward looking. So we're experiencing it now, and in the days ahead, we're going to have backward looking data looking at what we already had gone through. So my suspicion is we're going to see companies and countries talking out of both sides of their mouth, which is to be expected. So if we fast forward out into June and July, and hopefully this is all behind us, we're going to have companies and countries saying, hey, look, those months back there were ugly, and here's what we reported from it. But hey, look, we've got a great runway ahead of us. There is a lot of catch up to happen. Goods that we couldn't sell, we're now shipping. So we suspect that companies are going to have to tell two stories: what was and what they see ahead. And the markets a lot of times like what we see ahead. So if this is anything like SARS, Zika virus, and so forth, we got V-shaped recoveries out of those temporary issues. So the bottom line is, this is a dynamic situation. It's constantly changing data, headlines. We remain calm and focused on investing for the long term for our clients, because we're not investing for a few months for most of our clients. It's the long term. And with that said, in some of our models, we actually look opportunistically at this type of situation, because there's some companies or investments we've wanted to make, but the markets have been stretched. So we're concerned, we're watching things, and we're also a little bit opportunistic where we can be in some of our models. But as always, if you have any questions, issues, concerns, worries, please reach out, talk to us. That's what we're here for.